In the last video, we talked about what mutual funds are, and mutual funds have their place, but they used to be an awful lot more popular than they are at this point in 2020. And I want to give you a couple reasons why, and what people use to replace them we'll talk about in the next video. So there are three problems that mutual funds have that really make them less profitable than you would want them to be. The first thing is that you might think that an expert on the stock market is worth paying for, that they're bringing value because they've got their expertise and they're spending all of their attention on making sure that whatever part of the market they're looking at, they're making great decisions about it. People have done research about that and found out that really experts don't know a whole lot more than the rest of us, as it turns out. They can make good decisions. They could have good quarters and bad quarters, but when you average them out, they really don't do as well as the market as a whole. We'll talk about what that means in the next video a little bit. The second problem is not just that their decisions aren't great, but that you're having to pay to get them. So managers' fees can really eat into the profits that you make from holding a mutual fund. So let's say that you are in a mutual fund that gains 7%. So that sounds like a good amount of money, but you have to pay 1% in fees to the fund manager. So all of a sudden your 7% goes down to 6%. And that doesn't sound like a lot of difference, but when you compound that over 40 or 50 years, that's a lot of money that you are sinking away in something that has to have a fund manager. And the third is slightly related to that. It's not just the money that you have to pay the fund manager, but it's what the fund manager is doing. The fund manager is, like I said in the last video, if your fund manager is keeping a look at United States airline stocks, they're keeping a look at the industry, and they're buying Southwest and they're selling United, or they're getting rid of their Delta and buying something else. I don't know. But every time you make a stock trade, every time you buy stock or sell stock, you've got to pay money to do that. And you've got to pay some taxes along with that, and you've got to fill out some paperwork. It's just a lot of hassle around buying and selling stocks. And when you have a mutual fund, we say that that's actively managed, which means that that fund manager is looking to buy and sell stocks on a regular basis. So you've got to have all of those fees. They're also whittling away your profits. So actively managed mutual funds have those three things working against them. First of all, that there are high fees that you have to pay the fund manager to do their research and do all of their work and everything else that highbrow fund is doing, like advertising the fund and other things like that. Number two is this fund is actively traded, so all of those buying and selling that they do depresses your profit as well. And the third thing is that the advice that you get from the fund manager isn't necessarily worth what you're paying for it, because they can make wrong decisions just like the rest of us can. There's an alternative that gets rid of those three drawbacks, and we'll talk about what that is in the next video.